Here we go. Money talk.
Here comes the money. Money, 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 money.
That's a great intro.
That is. Good morning, Vietnam. I think we're gonna have to keep that. I really like
Robin
it.
Williams.
I like it. Robin Williams, R.I.P. That guy was a legend.
I'm a big fan.
I'm a big fan too. So, today I really wanted to dive in more into the 10-year, what the correlation is to the bond market, what the correlation is to mortgage rates, specific to non-QM rates. So I'm going to ask you to pull up that chart that we have, courtesy of MBS Highway. Shout out to Barry Habib.
Thank you, Barry.
He's a legend in our industry, and he provides us graph charting and a daily alerts, so we know sort of what's happening. And if you see those little purple locks, that's when he indicates of when we should lock our rates and what we should do.
So historically, this guy's been pretty on the money.
Yeah, he's been pretty on the money. And if you just see how long of a chart is this for, Alan?
This is 1 year. Do you want me to up that?
Yeah, go back 2 years.
2 years.
Actually, you know what? Let's just go back 6 months. Go back 6 months.
You got it.
So we can see where sort of the market's been over the last 6 months with the 10 years. So if you go back down, the lower the 10-year bond, the better it is for mortgage rates.
And why is that?
But because they trade directly in correlation, because there's a spread. The 10-year bond typically is what's the benchmark for, where mortgage rates will lie. And typically this is where the rate that the Fed or so typically lands about too as well. That's typically what they trade in parity.
Okay.
And that is where banks borrow money to money, and that's really where, their level of money that they borrow is.
So it's
Now-
simply the 10-year goes up, the bank's lending money to themselves, that interest rate goes up, mortgage rates go up.
Correct.
Okay.
Correct. Because their cost of funds are typically higher.
Got it.
Right. So now they're not going to give the rates to what their cost is. They're obviously going to be a spread.
Right.
Now, historically, it's been a little bit tighter, but recently it's been a parity of about 2.5 to 3% difference. And, as there's more insecurity and instability and volatility, there tends to be more of a spread
Okay.
because they don't know what's happening. So that's why, excuse me, that's why there's that spread. So if you look at it over the last 6 months,
Yep.
we were trading down at about the low 4%. Maybe we ticked a little bit under 4% or 4% right there. And then as we got closer into going to 25, January of 25, if you look at it, if you go to that top peak over there, we were at 480. So that's right around the week before Trump got inaugurated into office.
Right.
And if you see, there's a gradual downward progression from the time that the inauguration happened. And then we kicked up a little bit all the way down. And if you go a little bit more, right there is about where we started. Go to April.
April's here.
No, a little bit further back. So a little bit back. So this is right where we started with all of the talks about the tariffs and what we're going to do and where Trump really got aggressive with this plan of, Liberation Day.
Yeah.
And if you look at it, at one point the market took it and was like, wow, this is unbelievable, amazing. There's such good things happening
Right.
in the bond market because the stock market sold off so much.
Sorry, I'm looking up what date liberation.
Yeah, let's look that up with the so. No,
let's
that's
see.
not right.
People copying us. Liberation Day somewhere else? I don't think so.
April 2nd. So if you go back now to April 2nd,
So April 2nd's right here at
Yeah.
this drop.
so that's where everything was, and that's where the stock market completely tanked, and everyone is like, "Oh my God, this is crazy! This is nuts! What's happening?" And there was an immediate flight to quality.
Right.
Because when the stock market sells off, typically the bond market improves, so they don't have to pay such a high yield to get people to put money into the treasuries.
So the yield is how much the government's willing to pay you on the return of this
Correct.
bond. And so
Correct.
they don't have to incentivize you with a bigger return because you're coming anyway.
Correct. Because there's no other safe investment. So this is a
Right.
safe investment, guaranteed money. So on, when was that? We went all the way down to 389. Yep. And what day was that? April 4th.
2 days later.
2 days later. And then all of a sudden, we spiked up every single day. And the market was still going down. And then today we were having a conversation in the morning, and there was speculation China was selling their treasuries. It turned out who was
Japan and
selling?
Korea. Yeah.
Japan and South Korea were selling their treasuries, amongst other
Right.
factors that are involved. And now today, if you look at it, we're markets down. The treasury, the 10 years at 455. So from 389 to 455, that's almost a 70 basis point swing.
Yeah, it's crazy.
So now I'm going to tie this into a little bit of the correlation between regular traditional Fannie Mae, Freddie Mac conventional loans where you qualify with tax returns and traditional,
Yeah, how
big
does this
box
affect
banks
us? Yeah.
versus non-QM rates. Okay. So at the time when the rates dropped to that, the Fannie Mae rates were somewhere around 6.65 to 6.7.
You're talking about right here?
Yeah.
Got it.
So when we drop there, so if we're at 389 and the market's trading at 6.7, what is that? 389, 4, 5, so about 3%, almost
Just about.
3%. Okay. And the non-QM rates were trading, because there's a little bit higher because of the risk factor. We're not using tax returns or anything like that.
Right.
We're trading somewhere around 7 and call it a quarter, 7.375. So a little bit higher. Now, that's for owner occupied.
Right.
But here's the crazy thing. For non-owner occupied investment properties where you have a ton of money that's been flowing into the investment properties, Fannie Mae was when this was down to 6.6, 6.7, they were at like 7.5.
Right.
Whereas see, so we got to learn to lock. Whereas your non-QM rates were right around 7.5 as well. So they were pretty much trading par to what Fannie Mae
Right.
was. So there's a lot of opportunities. Sometimes even if you do qualify for the traditional
Conventional.
Fannie Mae, there may be advantages and leverage points to qualify for
Non-QM.
non-traditional, non-QM, because you may be able to qualify for more of a home, better opportunity, because that limits you into sort of your restrictions. But getting back to the numbers, if you look at this, the way this shot up, we're at 456 right now, and your 30-year on Fannie Mae is trading probably, I would imagine today, it probably adjusted to 7.25. I would imagine. I wouldn't think it would be less than that. I would probably think that regular traditional. Meanwhile, we didn't raise our rates.
Right.
We adjusted when it started going up, but we don't keep adjusting every single time there's an adjustment. So now we're even more in line with the conventional rates. The conventional rates are much more sensitive to these type of market volatility, where the non-QM market is really much more looked at a holistic measure of who the borrower is, what there is, and
Right.
there isn't as much volatility in the movement. So it's very important, to see what the impact of these tariffs, because the tariffs are really a tax.
Yep.
Now, a lot of people are talking about, oh yeah, the rates are coming down, everything's going to be great. There's going to be, in the beginning, before all of this tariffs, they were talking about 3 rate cuts this year alone.
Yeah.
And, even though the CPI and the PPI numbers came in better
For February.
that's
For
the
March.
problem.
It was
But
February.
it's prior to the tariff
Right.
implications. So no one knows. So the market didn't react well to that at all because they don't know what's going on.
So generally, what would have been a good sign,
100%.
We have to
What
overlook.
outside of a tariff environment, this would have been an amazing sign. We would have seen
rates
the-
would have gone down.
Yeah,
things
rates would have gone down. Everything would have been great. But we're here, and Jerome Powell is staying steadfast in his belief that I'm not reducing rates. This is something that we really have to watch and see what happens, because tariffs tend to be inflationary.
Right.
And the good thing is the president cannot remove Powell. Cannot.
Right.
He's not one of his board members or whatever that he can remove him. And actually, President Trump put in Powell
Back in his first term.
back in his first term. Correct. And it's a 10-year term, but he's doing a great job, in my opinion. And
Yeah.
I mean, he took what was crazy inflation. I mean, obviously, they didn't react quick enough on the uptake.
Yeah. I mean, if we look at the history, you can see the movement. I can up this to 5 years, I believe.
Yeah, this is a 5-year.
You can see things really took off in 23. I mean, the spike was huge and then it slowed down, right?
Yeah. That's
So-
when the rates started going up. I mean, rates were at its peak in probably 23,
Yeah.
mid 23, beginning of 23. And people were still buying. We were having that conversation. People were buying in the 9.5 range, where now we're in the 7.5, probably 8s now, depending on where you land. But at the end of the day, there's still so much opportunity and so much money flowing in, because what these tariffs and everything doesn't affect existing home sales.
Right.
It affects new builds. It affects the people that are going into these, tracks of homes, KB homes and GL homes, and all of these builders, because their cost of lumber, cost of construction, cost of everything is going up
That's going
$10,000, $15,000, $20,000 a pop, and that directly gets passed over to the consumer, and they're not going to be able to qualify because they
Yeah.
just don't have the ability to, and affordability becomes a problem.
If I could ask a couple things.
Sure.
If I know that we're saying tariffs don't affect constructed houses already, but I would argue that one of the biggest economic factors in pricing of homes is availability, supply, because especially in those earlier numbers right there, 23 and even earlier after COVID, we had supply issues in the States, and house values spiked, and they've come back down slightly since. They're back on the rise. But if less houses are being built because it's more expensive, existing housing prices will also go up.
Yes.
Right.
Now, certain areas are flooded with inventory. I mean, look at, for example, Sarasota. It was one of the hottest markets in Florida.
Right.
Now their inventory is at a 6-7 month supply.
So as a response to that influx of people, the construction took,
Everything, and people started selling, existing people, you had a lot of people that were in very low rates, but they were at an impasse because they had a change in their family, they increase or whatever they needed to make a move.
Right.
And for so many people, they just didn't do anything because they were tied to that low rate. And at one point, there was a shift in the paradigm where they're like, okay, I can't take it anymore. We have to do it. Rates aren't coming down anytime soon. They accepted the inevitable, and then they started selling. Now, some people put their homes on at such ridiculous prices.
Yeah.
So those are the ones that are sitting on the market, which is causing, mixed signals, because you're saying, oh,
looks
homes
like
are
things
sitting
aren't
listing
selling.
on. Yeah, but the truth is they're overpriced.
Right.
Homes that are priced well are still flying off the shelf.
Right.
But you have some markets in South Florida here, and I'm biased to Florida, but it's not just Florida. You have Texas, Florida, the Carolinas, any state that you're seeing a lot of population growth and job creation and that flight to, hey, liberation, if you want to call it that.
And affordability.
Yeah, and affordability. So you see, state taxes are a big thing.
Sure.
We left California. One of the reasons also was the state tax.
Yeah.
Florida doesn't have any state tax. That's a big number.
I think they're trying to get rid of property tax too, right? In Florida.
Yeah, for a certain, like on the federal level, on the state level rather, but the county
Right.
level has to have the tax in order to have, pay for schools and do all of those things. But again, everything helps, and every little bit helps. But it speaks to the mindset, to what's going on in today's real estate market. There's going to be always opportunity, in my opinion.
Yeah.
And financing now more than ever has to be paid more attention to, because in 2020, 2021, almost 2022, you could throw a dart.
Money was almost free.
Yeah. So anything would cash flow, anything would make sense, and you could buy anything. But now you have to be strategic, and more importantly, financing really becomes a major factor, where you can't just say, oh, non-QM is not for me because it's too high. Not always. Sometimes you may qualify for more of a home
100%.
and it makes sense,
Yeah.
you know, because everything in the conventional world is a tighter box to begin with. Not to say we're loosey goosey. The performance of non-QM loans, you know, from when COVID hit, was significantly better than any conventional marketplace.
Right. And I think one of the things to keep in mind is that when you're looking at investments, I think you put this best yesterday. When you're looking at investments, the number one factor in your purchase or your refi is, does it pencil in the moment? And the number two factor is, this is like any other investment, especially in real estate, not a short-term play. You buy the house, you date the rate, you marry the house, right? So, you know, if you could see in this spike right here, there's people who purchased in 2020, 2021, and even they realize that, you know, money is a commodity, money is, you know, a tool. So those people might have refied here in 2023, and they might have taken a rate 6-7% higher than where they were at because they needed that equity, because they're expanding their portfolios, they're making other business decisions. And those same people, 2026, 2027, rates come down, they're going to be refining again. They're going to be doing the exact same thing.
Absolutely, man. But if you look at it just from a math perspective, you know, a higher rate may cost you a couple $100, $200-$300 a month. Right. The maximum duration, in my opinion, that anyone's going to be in a home in this higher interest rate climate, if they're in, is probably 3 years.
Yeah.
Where I think rates will come back down and level off, maybe sooner, but I think 3 years. So even if you take $250, extrapolate that over 36 months, what's that? $10,000 almost?
Something like that.
Yeah. So $10,000 is nominal compared to the average home price going up 3 to 5% a year.
Exactly.
I mean, prior to these last couple of years, you were seeing 7, 10, 15, 18% increase in home prices.
And I know that people that, you know, we financed in 23 are getting refis now. It's only been a year. You know what I mean? And those people are already taking a 1 to 2% discount on their rates, but they got that house at a great value. They got that house at a time when it made sense for them. And now it's making more sense.
I mean, we're doing a deal right now for a guy who bought a home hard money about just a little less than a year ago.
Right.
And he did improvements to the home. The home went up probably $80,000, $90,000. Now he's doing a refinance, dropping his hard money rate, and he's still better off than where he was. But if he would have not bought the home, he wouldn't have picked up all of this extra equity. You know, so he paid, I don't know, $5,000-$6,000 extra in interest.
Right.
But look where he's at. And I think that has to be the mindset, because at the end of the day, you're never going to catch the bottom. And I don't think you're ever going to hit the top.
And if you do catch the bottom, it's not on purpose.
Yeah, it really isn't. I mean, it's not a science. It's more of just understanding what you're doing. I mean, housing and real estate has always been the stable in the United States. Yeah. I mean, no matter if you go back 50, 100 years, it's always been consistent. You buy a home, it goes up in value at some point in time.
Right.
But over a period of time, going back into the 50s, where every economic crisis that there was always dips, and then you come back, however long that cycle would take.
Right.
Now, when you look at this in the next 2, 3, 4, 5 years, in my opinion, this is just going to be one of those blips.
Right.
And then you're going to come back. I mean, everything is cyclical. And the difference, a lot of people say to me, oh, Meyer, you know what? When we first started doing non-QM loans, we started doing these non-QM loans back in 2013, when it was like unheard of. Right. And when we were doing this, it was Alt-A lending, and people were talking about, oh, you're doing liar loans, you're giving people money. No, we're checking their bank statements. These people have skin in the game. It's completely different. In 2008, you could buy a home with 100% financing, showing no income, nothing. It didn't matter. You had a heartbeat. You got a loan. Yeah. Here, we're doing checks. We're validating. We're balancing. We're checking everything. And we were one of the pioneers in the non-QM space, dealing with the direct consumer, dealing with the retail. And it's evolved so much. And people at that time, when we first started doing, rates were 9.5, 9.99. I remember it was a great rate.
Yeah.
and
Unheard of.
things, and things that, but people were buying, and it was normal back then. You know, it just became so abnormal when rates were 2.5%, 3%, and people got used to that.
Yeah.
But it's
Yeah.
not going to last.
Yeah,
you know?
exactly. The next generation is not going to know what that 2% or 4% feels like. You know, hopefully one day we get back to 5 or 6, but that was a once in a generation, once in a lifetime.
But I think COVID really did a number on everyone and everything, and and created this, I don't know, hyper crazy warp speed acceleration of a lot of things.
Yeah, it did.
And because so much money was also pumped into the economy,
Yeah.
that also
Inflation. for sure.
accelerated everything. So, you know, I don't know. I mean, hindsight's always 2020, right? If you look back and say, what happens if COVID didn't happen?
I wonder what the real estate market would look like if
Correct.
COVID never happened.
You know, I mean, I definitely don't think Florida and these states that had massive
exploded
growth
like
would have
they did.
exploded that way.
Yeah.
I mean, even where I live in Boca Raton, if you looked at the life cycle of the homes were steady 3%, 2%, you know, 1%, 0% gain over year after year after year. But from 2020 to now,
Yeah.
homes are up 100, 150, 200%.
Now, do you think that was every state, or do you think that was just states that were a little more lenient during COVID?
I think that was the states that were more lenient than COVID. I mean, look, if you see the Midwest,
Yep.
the Midwest historically has been steady 2-3% growth year over year over year. You don't really see, but California is an anomaly. Even though they had lockdown, they had everything. California, I mean, being the largest economy in the United States, and what is it, the third or fourth largest in the world or something like that?
Just to prove your point, this is COVID right here. There's the property values average in Florida. This is COVID right here.
Yeah.
That's crazy.
I mean, you know, in my development alone, people became millionaires overnight because they bought these houses. I mean, 20, 30 years ago, $200,000, $250,000. Now their house that they never had the dreams of being worth millions or millions. It's crazy. But again, it speaks to those outside forces.
Yeah.
You know, you think, I mean, could there be another COVID-like type of situation? You never know.
Yeah, right.
But what would that look like? How would the world react? I mean, how would the future generation be able to deal with something like that? I mean, we were shut down.
I think it's interesting because what you're talking about, like these people who owned the homes prior, right? You're kind of, to go backwards, you're talking about how real estate is a secure investment, right? Well, I don't remember a time in history since maybe 2008 or the Great Depression where a chart looked like this, but upside down. So I think if you own real estate, if something like that happens again, this might be the result again. You know what I mean? So it's a secure investment in case something like that happens.
I mean, yeah, because at the end of the day, and again, the stock market too, you can look at the stock market, the S&P. If you
Right.
do a 50-year extrapolation of the S&P,
Same thing.
Right.
Right.
You know, and I mentioned this the other day. I listened to a podcast, and this guy was 30 years old. He's like, you know, I've been waiting for 15 years to catch the bottom. And the host of the podcast are like, what's wrong with you? In the last 15 years, look at where the S&P is and look where it is today.
Right. Look what you could have made.
You could have made 8 times on your money, like crazy. Right. And they're like, just get in.
Right.
You know, you're young, you're 30 years old. You're not a day trader. It's not affecting you day to day. You know, if this is a long term, it's a long term. Set it and forget it. I mean, that was the common terminology. It's just don't look at it. Just leave it alone, leave it be, and just move on.
And that's how you feel about real estate as well.
I do. I think that it's very important to have an asset. You know, it's very important. And look, there's a couple of people like Grant Cardone says, don't ever own a primary residence. It's the worst investment you can make. I disagree with that. I mean, you always should have a primary. You know, I do believe in investing in cash flow properties. I do. But it's not so easy for everybody to have apartment buildings and whatever the case may be. But, you know, it's important to have a home. It's important to have something that you can call a legacy. There are a lot of people that live years and years and years renting, and they say they're happy. They are. But at the end of the day, they have nothing. You know, you look 30, 40 years, you lived in the same place.
Right.
You paid off the mortgage of the landlord.
Right.
And What do you have left to show?
Yeah.
Nothing.
It's a very interesting topic, but I think one of the big like takeaways here, the big roundup is this is scary, right? What we're looking at is scary. The tariffs are scary, but ultimately your advice doesn't change. Your thoughts are, this is a rough patch. Maybe it goes away. Maybe it takes some time to go away, but it doesn't matter.
At the end of the day, it's all going to level out in the next 3 years, in my opinion. Whether your rate is at 7.5, 7.25, 8, 8.25, it doesn't matter. No one's staying even at high sixes, even if you go regular conventional rates.
Right.
No one's staying here. I mean, I believe that eventually inflation will curb out and everything will be, and it's all cyclical, and the rates will come back down to level off, and you'll be in the high fives, 5.5, maybe somewhere around there. So everybody is going to refinance again. And what are they going to do? They're going to cash out of their homes. They're going to move up. They're going to do the same thing, and it's going to create that cycle again.
Right.
I don't think we're ever going to run into that inflationary thing again, just because there's no need to print so much money the way they did in COVID to stimulate the economy. And
Let's hope there's no COVID-22.
That's right. Let's hope there's no leak from somewhere or anything.
Or whatever happened. I think that's a solid spot to round it off. Taking that advice to heart, I think you should look at these as moments of opportunity, because just like we see it's 4.5, 4.6 right now, what was it? Maybe 1 week ago, it was 3.9, right? So trying to aim for that 3.9, everybody wants to do it, but you shouldn't wait. You shouldn't try to be the guy who got it right here. You should just be the guy who gets it in this area.
Correct.
Right.
Correct. And whether you get a 7.25 or 7.5 or 7.75, at the end of the day, it's all the same thing. What you're getting in, and that's really the keys. Our advice: just get in the game. Don't hedge. Don't hesitate. Don't wait. Just take action.
Nice. I like that.
Thank you so much. Appreciate it.
All right. Have a good weekend.
You too.
Here comes the money.
Here we go. Money talk.
It's a great song.
Here comes